Good morning. This is Barry Knapp with Ironside's Macroeconomics. It's Monday morning, January 12th at about 8:20 Mountain Time. Our note this week was titled Broadening Boom. And there's no doubt that everything we were and have been recommending worked last week. The equal weighted S&P outperforming the cap weighted S&P, cyclical sectors outperforming defensive sectors and outperforming tech. A trade we've been recommending for a long time, which was to bet that the spread of mortgages relative to treasuries would tighten, received a jolt when Fannie and Freddie announced, in essence, or the president announced they were going to buy $200 billion worth of securities. There's unanswered questions around that, including are they going to hedge the volatility risk associated with that, like they did before the pandemic. But to get into all those details, become a paid subscriber to Ironside's Macro, and you'll be able to get all the good details around this. So we began with a broader discussion about having this broadening boom in the markets, yet not having data that's supportive of it. Yes, we know the productivity numbers were really strong, but they're flattered by some GDP accounting. Remember, that's just a residual of growth versus hours worked. Hours worked are not growing at all, and that was confirmed with Friday's employment report. There was no increase in hours worked. Labor income is falling. Average hourly earnings for production and non-supervisory workers decelerated sharply through the course of the fourth quarter. Labor share of income is going down. None of these things create a sustainable broadening boom. So there is no real evidence in the data that that's occurring. Maybe the markets are ahead of the data. We shall see. But nonetheless, we thought it was a very interesting juxtaposition, and it made us a bit nervous. So within the note, we went through the data we saw last week, including flow of funds data that does show the household sector continuing to deleverage. The debt to GDP level or ratio of the household sector is back to 1999, having now retraced the entire 2000s boom. So there's, a good underlying core setup for the household sector. But remember, it's super K-shaped here. And that was a note that we wrote this week too, previewing the employment report, was the K-shaped labor market. So within that labor market report, we saw weak hours. Hours worked were down back to the cycle low. Aggregate hours index, which is total as hours worked, didn't grow at all in the fourth quarter, as I mentioned. Labor income's down. Average hourly earnings is down. Job growth is really weak. So again, we've got a soft labor market. We then went on to discuss a section we titled, If You Tax Something, You Get Less of It, the plunge in the trade deficit that we saw last week. Now, that may have been overstated because of pharmaceutical tariffs and some front running of that, as well as some drop in gold imports. But nonetheless, we do have what looks to be the early stages of a drop in our trade surplus, like what occurred in the 70s. We do not think that people have thought through the full ramifications of that, which could include intensification of the producer deflation that's occurring in China, and that may spread to the rest of Asia and could affect global capital flows. So again, become a paid subscriber and you can see all the details and where we went with all of that. Now, that's a risk to keep in mind. We do think the dollar will go down this year, but thinking that this whole global rebalancing is going to be smooth and orderly is a little bit Pollyannish. Undoubtedly, it will have its points where the stress really intensifies and causes risk-off episodes in the market. We may get to a better place where we're not absorbing the world's trade surpluses, but we doubt we'll get there particularly smoothly. So we wrapped up the note with a discussion about this mortgage-backed securities duration easing, the effect of buying mortgages. Not only does it lower longer-term rates and term premium, it also does that through suppressing volatility. So they are very significant. $200 billion of purchases is a big deal. We now have that spread down to about where we thought it would go. We'll consider removing that recommendation to be long mortgages or long mortgage REITs. But we'd like to we still think there could be one more potential leg to this, which is small banks starting to really accumulate mortgages. That's dependent upon a slightly steeper curve. And the drop in the unemployment rate on Friday, and perhaps the actions of the Justice Department bringing suit on the Fed will dig in the Fed's heels. We'd have to say a rate cut in January is now off the table. We'll see if we move towards one in March. But we do think, and part of the reason we think we're getting a benign reaction to that, Powell's statement and all, is because the market agrees with our view that the Fed should be cutting another 50 basis points or so here, and that it's warranted by the incoming data. We'll see when we get CPI on Tuesday. It's something else we talked about in the note, offered a little preview around that, and we'll have more to say in this week's note due Friday morning. Or Saturday morning, excuse me. So that's it for me this week. On balance, as we said, leaning into this broadening out is working from a market's perspective, but the data is not supportive of it. It does make us a little bit nervous. But for now, at least as we kick off earnings season this week, that trade will probably continue. We haven't made any changes to our sector asset allocation yet, but we're considering them. Bearing that from Ironsides. Have a good week, everyone. Thank you.